Hey, good afternoon, everyone. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. Thank you, everyone, for being here. For this presentation, we're going to, of course, focus on charting and the different types of charts that are available on the TradeStation platform, specifically a concentration on price charts and volume charts. Before we get started, the usual disclosures, keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and that past historical performance is no guarantee of future results. We have all the disclosure links right here in this PowerPoint slide. But if you need more details, go to tradestation.com/important-information. And as a trader, it's great for us to have an understanding of all these different charts to find the one that best fits our methodology. A lot of times, we just use time-based charting just because that's the default one, and that's the one that everyone uses. But there's other very interesting chart styles that you have access to that allow you to see the markets from a different perspective. And for that, let me go ahead and start a poll. So this is a little poll asking you, what type of chart do you guys use? So make sure that you respond, and that'll give us an idea of what are the most used chart types here in TradeStation. There is a custom study out there in the Easy Language library that creates Heikin-Ashi candles. But this custom indicator, I believe someone that uses TradeStation created it, and you can find it in the TradeStation Easy Language library. Based on the poll, I'm not sure if everyone participated, but it seems that what I said at the very beginning is true. Everyone, or the majority of you, use time bars. 83% of the people here use time bars. 30% use tick. And then we have 5% share bars, 4% point and figure, 13% range and momentum, 1% Ks and Kagi, 8% Renko, and 3% line break. So we have, yes, a lot of traders that don't utilize all the other price charts. I'm not sure the reasons why. Maybe you think that they're not really that helpful, or maybe there's a lack of understanding on how they can benefit you. So let's go ahead and talk through all the different styles of charting, and that way we can start a conversation or a discussion about the pros and cons of all these different chart styles, okay? So let's go ahead and switch over to my TradeStation platform. Let's give my TradeStation a moment. I've noticed that sometimes I open up my TradeStation and it just stays like this for a while, and eventually it allows me to click on the different menus at the very top left. But it doesn't seem like it's crashed. It just seems like it's still trying to open up. So let's go ahead and give it a moment. And while that happens, let's go ahead and talk about the things that I told you I would do. In terms of Heikin-Ashi candles, let's go ahead and talk a little bit about that. I'm going to open up my browser. In order to access the Easy Language library, you have to sign in. So let me go ahead and sign in to the TradeStation Client Center. All right, and I'm going to go here and log in. All right, so this is the TradeStation Client Center. We have to go to the Support tab here on the right-hand side. That's where the Easy Language library is. We scroll towards the bottom, and here it is, Easy Language File Library under the Community section. I'm going to click there. There we go. Here in the Easy Language library, I have to search. So let me go ahead and do, first of all, let me go to the advanced form search, because that way I'm just going to search for the word Heikin, but I'm going to search the Easy Language library only, and I'm going to search the title only. So Heikin, Easy Language library, search the title only, search the forums. Okay, so here's the very top one is Heikin-Ashi candlesticks. This one is probably not the one. Okay, it's just referenced to another thread. Let me go back to where we were. And here's the thread. So this is a post that's called Heikin-Ashi bars. And if you scroll down, you're probably going to find a link that allows you to download. Here it is. This is an ELD link that provides you a custom study that creates Heikin-Ashi candles. So for those of you that are looking for Heikin-Ashi, just go and follow the same steps that I did here to access the Easy Language Library, and you'll find the Heikin-Ashi candles there. Again, this is not a study that TradeStation created. This is somebody that uses TradeStation and has extensive knowledge on programming and took the time to create Heikin-Ashi candles using easy language and use it as an indicator. You'd have to go to studies, add the study, and find it in there once you import it into your TradeStation. So give that a try, and I'm sure you guys are going to enjoy it. Let me go ahead and see if my TradeStation is back on. Oh, that's cool. So let me go to File. All of a sudden, when I was saying that I was going to shut down my TradeStation, it automatically responded. So let me go to File, Workspace, and open up the Workspaces that I wanted to show you guys. It's just a Workspaces, and I organized my Workspaces in terms of the charts that I was going to show you. So let me go ahead and sort here by, there we go, by date. And these are all it. Let me go ahead and open them up. Now, let me go ahead and this is done. So let me go ahead and go to this untitled workspace and close it. I'm going to start here with the volume workspace. This is the volume. Volume applied on a time-based chart. So this is the 5-minute chart, and you have the volume indicator at the bottom. This volume indicator that you see right there, it's a volume average indicator. It's a different study. If you just add volume to your charts, it'll be a single color. I think the default color is going to be red. But this volume AVG, or volume average, allows you to see color-coded volume based on what the price is doing. If the price or the closing price of the candle is higher than the previous one, it'll color the candle blue. But if the close is lower than the previous one, it'll color the candle or the histogram bar red. And you also see a yellow line that gives you the average volume for the security that you're looking at. In TradeStation, you have the ability to switch the way that TradeStation is reading and displaying volume. As you can see right here at the bottom, I'm displaying number of shares. So on the current bar, you can see on the red label on the right-hand side, that's real time, the number of shares that are being traded. The label in yellow is the average number of shares that have been traded in the past 50 bars. So it's interesting that we see all that information from one study. And I say this because I wanted to show you how to switch volume to a different read. I'm going to go here to the Data tab and edit the symbol. Because when you edit the symbol in this Customize Symbol dialog, you have the way to adjust the way that TradeStation is reading volume. You can see that for volume, right now my chart is using trade volume. And if you go to this drop down, you have the ability to set it to tick count. And the difference here is that trade volume is going to count the number of shares, and tick count is going to count the number of trades or transactions. If I set it to tick count and I click OK, notice that right here at the bottom, we can see the numbers change drastically because now it's not keeping track of the number of shares. It's actually just counting the number of times that Spider is being traded. So if you see the cyan number here on the far right, Spider has been traded 332 times in the current 5-minute bar. And in average, it's trading about 2,200 times every 5 minutes. That 2,200 right there represents that. How many times, Spider is trading every 5 minutes. This is important to kind of understand, especially if you're going to be transitioning over to a tick chart or a share bar. Why? Because you need to have an understanding of how every stock is trading. Not every symbol is going to be the same. Spider is a stock that trades at $456 per share. So the amount of trading volume may be affected by the price of the security. A very high valued security may not trade as much as something that is lower value because it's more affordable. Now, we know that Spider is highly traded, and it may not really apply to Spider, but just keep in mind that trading activity and volume is also tied in with the value of the security. And I'm saying that because when you look at volume study that way, it helps you realize, okay, what is the number of ticks or the number of shares that you want to use in order to create volume charts? Let me show you what I mean by that. I'm going to bring my tick chart over here, and I'm going to bring my shares bar over here. So we said that for an average, I'm not sure if you remember, but when we had the symbol switched over here to trade volume, the average was about 400,000. I'm not sure if you see that here. You see the number right here on the status line of the indicator, 399, 221. It's updating in real time. So I'm going to round that up to 400,000. I'm going to go to the shares bar and I'm going to type in 400,000 share. This is the way that you send the command using the command line. You can use 400,000 share, and the chart will take that as a command to change the chart style to 400,000 shares, meaning that every candlestick will be built based on that number of shares. Every time that Spider trades 400,000 shares, it'll have a candle. Let me hit enter here, and there we go. And the 400,000 share bar is comparable to the 5-minute. The only difference is that you may have more candles than in the time-based chart. And why is that? For the simple reason that when you create a time-based chart, every candlestick is exactly the same amount of time. If you set it to 5-minute, every candle is 5 minutes. And every day, you're going to have the exact same number of bars because the day is divided into equal time segments, in this case, 5 minutes. But when you build a chart that is sensitive to volume, then the more volume there is, the more candles you're going to see on the chart. So these are charts that are sensitive to trading activity, which is something really interesting. That doesn't happen with a time-based chart. The time-based, I mean, you see the candlestick, but unless you have a volume indicator, there's a disconnection between what the prices are being traded on a 5-minute and the amount of volume that's being traded on a share bar, and the same goes or applies to the tick bars. These are both sensitive to trading activity. If the market slows down and there's not that many trades or that many shares being traded, the chart will slow down as well. And when activity picks up and there's more trading activity or shares being traded, you're going to get more candles. This is very useful, especially if you're following volume sensitive technical analysis, or if your strategies that you have on the chart are sensitive to trading volume. It's great to have these charts because if the market is active and there's more bars coming in, the strategies and the indicators have more opportunities of being calculated because more bars are being drawn. Hopefully that makes sense. On these types of charts, this is a share bar chart, you can also use a volume study. So if I go here to studies and I go to add study, let me go to my volume average. Here we go. Of course, we're following 400,000 share bar. Take a look at volume here. It looks like a flat line. Why? Because every histogram bar is going to be approximately 400,000 shares. We're following the same concept. On the candlesticks, they're being built every 400 shares, 400,000 shares, and the volume bars are pretty much representing the same thing. So we have that flat effect. So in a chart like this, instead of monitoring number of shares for volume, it just makes sense for me to go into data, edit symbol, and switch my trade volume here to tick count. That way, I can see how many trades it took to accumulate 400,000 shares, which is an interesting concept. You can see some candlestick or some histogram bars that are bigger than others, mainly because there were more trades required or less trades required to accumulate the 400,000 shares. Take a look at, for example, yesterday towards the end of the day, we see an increase of trade size because it took less trades to accumulate the 400,000 shares that are required on each one of the candles. So that's an interesting interpretation of volume and what happened during specific time periods. Let's go ahead and do the same thing here for a tick chart. Our tick chart right here is set to 5,000. But if I go here to volume, I know the average. Let me take a look at the average. Edit symbol. tick count. The average is about 2,200. I think we had seen that already. So this gives me a comparable chart. If I switch it to 2,200 ticks, it gives me a comparable chart to the 5-minute time frame. So I'm going to go to the ticks chart and set 2,200. Notice that I'm typing it in right here into the command line and following it with the word ticks. 2,200 ticks. I hit enter, and this chart, of course, is going to build the candles every time that Spider trades 2,200 times, which is pretty cool. The more trades there are, again, the more candles I'll receive. I see a question right here in the chat that says, does this work on futures? It definitely does. I'm using, spiders as an example, but feel free to use any asset class as long as it has volume, of course. It's going to work exactly as I'm just showing you. Let's go ahead and take a look at other types of charts because these are all activity based. So just to recap, we started off, showing you some time-based charting, and then we transitioned over to activity-based, the ones that are sensitive to trading activity, either number of trades or number of shares being traded, which is pretty interesting when you're following volume. Let's go ahead and switch over to another type of chart that uses price as the focus. It doesn't use time. It doesn't use volume. So it doesn't really care how much time has passed. It doesn't really care how much trading volume there is. All that it's looking at is where the price is moving. So it's a chart that is based on price movement. And that's the one that has the most variety. We have a total of 7 different price-based charting. Again, charting that does not take into account time, and it doesn't take into account trading activity. It's just looking at price. And price, of course, is what ultimately is going to provide you movement in your portfolio. Whether you're monitoring your profits or losses, if the price is not going anywhere, if it's static, your portfolio value is also going to be static. So it's important that we think about that connection, that price is ultimately what's going to represent an increase or decrease in our overall portfolio. Let's start off with point and figure. Let me switch over to my PowerPoint. I believe I have a point and figure chart here. Okay. This is what the point and figure looks like. And it's going to use X's and O's in order to represent price movement. It's going to use the X's as the prices go up, and it's going to use O's as the prices go down. Now, it's interesting that we understand the way that the chart is being built, and so that we can have a full understanding on what is it that we're looking at. But the idea behind, and this is true for every price-based chart available on TradeStation, the truth is that these charts are going to filter out noise, the noise that happens in the markets, because you could be in a very clear and defined uptrend. So you see the prices are going up, right? But in the process of prices going up and sticking to that uptrend, you're going to have a lot of ins and outs, a lot of ups and downs. And in some of those areas, you're going to doubt that the price will continue in that same direction. If you're in an uptrend and you see a little small correction, then of course everybody's going to look at that correction and say, is it time for the market to change direction and then go on a downtrend? So a lot of times those little corrections are considered noise, and price-based charting is there for that purpose, to remove all that noise, because it's concentrating on price movement mainly, and it's going to filter out any price movement that does not meet a specific threshold. So if there is a price movement in the opposite direction that you're following, if it's not a significant price movement, you're just going to ignore it. Now, it's hard to ignore it when you're looking at a time-based chart, and that's where you see the ups and downs and the noise. Price-based charting is going to take care of that and remove all that noise, because you're going to set a threshold. Let me switch over here to my TradeStation platform, and take a look at my point and figure. This is my point and figure. You can look at the time scale of both of these charts. By the way, I just have a daily chart here on the right-hand side. We're still looking at spider, but this applies to any symbol that you can put on a chart, including futures. But you can see the time scale right here at the bottom, and you can see that both charts start around September, right? We have September down here, and we have September over here on the right-hand side. And you can compare the movement between the two, right? And you can see that sometimes whenever you have a big red candle, like over here and over here, that is reflected in this area. But as the price is going up, you're going to see a column of X's. When the price drives down, you're going to see a column of O's. Now, what drives the switching between a column of X's and a column of O's? That is something to keep in mind, because as a chartist, you're going to have to supply what the size or the price movement you're looking for is. If I go to the data tab and I go edit symbol, for spider, I picked the box size of 1. So if I set it to 1, what I'm telling the chart to do is to monitor any price movement that totals 1 whole point. Maybe I think that 1 point movement in spider is significant. And when I think about it, maybe it's not so much, considering that spider is priced at $455. A 1 point movement is not really that much, right? So if you want to maybe filter out more noise, you can consider increasing the box size to something that is a little bit more significant. A lot of times what I do in order to have an idea of what to set my chart to is I usually use an indicator called the average true range, because it gives you an understanding of how much the security is moving per bar. If I go here to studies, add studies, let me show you what I mean by that. I'm going to look for my ATR indicator. It's just called average true range right here. I'm going to click OK. And you can look at the average true range on spider, and you can see that it's $3.61. What that tells me is that in average, every bar moves $3.61. Now I can set my daily chart over here. Well, this is not a daily chart. This is a point and figure. I can set my point and figure to monitor 3 points instead of 1. Just to remove a little bit of the noise that is happening here. It seems like my point and figure at this moment is sensitive to those little corrections that happen in the market, and I may want to filter those out. Let me go ahead and go to data, edit symbol, and then set the box size to 3. I'm going to leave the reversal on 3, and I'll explain what the reversal is, because reversal is what determines at which point the chart is going to switch from a column of X's to a column of O's, or vice versa, from a column of O's to a column of X's. But it's going to be a factor that is multiplied by the box size. When I had it at 1, the reversal here is 3. So we multiply 1 times 3. So we're looking for a movement of 3 points in the opposite direction in order for it to switch from a column of X's to a column of O's, or vice versa. But if I change the box size to 3, then what I'm saying is that I'm monitoring a 9-point movement, because 3 times 3 is 9. I'm monitoring a 9-point movement in order to switch from a column of X's to a column of O's, which is a significant jump. So just remember that the reversal, it's a factor multiplied by the box size. So let me go ahead and click OK to that. The chart is going to rebuild using, the new numbers that we provided it. If I open this up, you can see that from September, this is September down here, it actually just created 4 different columns, which is very interesting. And you can check the date, approximate date when the switch happened, by clicking and holding on this column of O's. You can see that it happened November 1. You see the date right there on the data tips on the top corner, top left corner, 11/1/23, November 1st. That's when it switched over to a column of X's. When did that happen here in relationship to this chart? That happened somewhere right here. From that point on, you can see that Spider has been in an uptrend. And if we don't count the red candles, you can see that the uptrend is very evident, and it's very evident right here in the point and figure. Now my point and figure is not sensitive to these corrections because they don't meet the 9-point movement in the opposite direction that I'm trying or monitoring or tracking. So it's a very interesting way of looking at price and not having your chart move when small corrections happen. A couple of things happening here as well. Everybody sees the arrow that is pointing here towards that column of excess, and that goes along with the current price of Spider, 455.23. Do you guys see this little dash, more of a color red, pointing also right there to the column of excess? That little red dash represents your reversal level. Of course, you can draw a line just to have a more visual of where that is. But if the current price, which is 455.20, touches that reversal, that is the point at which my point and figure is going to switch from this column of X's to a column of O's, because now it has met that reversal amount of 9 points, and then it switches. But notice how much control you have over the chart. So there's a couple things that you have to always determine. First of all, what is it that I consider to be a significant price movement? And what is it that I want to set my reversal to because it's a factor? So keep those things in mind because it's going to be different for every security that you trade. But I wanted to give you this example so you can see that now I'm filtering out those red candles where the price apparently was heading down, but they were just small corrections in the price activity. All right, let's go over to the next price chart. Renko. Renko is the type of chart that also uses a significant size, but is provided by the user. So you tell the chart, what is it that you consider to be a significant price movement? The only difference between Renko and point and figure is that there's no reversal factor. This just monitors the price movement based on the amount that you provide. So if you set it to 5, every time that it moves up 5 points, it's going to draw a box. And anytime that it moves down 5 points, and not from that highest point, it's from the point that it started, then you're going to get another box. Let me show you this on a chart so that we can explain it a little bit more. Let me jump over here to Renko. This is Renko for Spider. Again, we can see that it's a little sensitive to those corrections that we saw on the daily chart. Notice that this is the beginning of November. We already analyzed this portion of the chart. And the reason for that is because my Renko is set to 1. I can, of course, change that. Let me go ahead and go to data, and edit the symbol. You see, that's the brick size. That's what you consider to be a significant price movement. If I change that to 3, as we did on the point and figure, let me show you what that does. This is going to take a moment to calculate. What I want to show you here on the Renko is the beginning of November here. Now you can see that since we're considering the 3-point movement a significant price movement for Spider, now you can see that it removes those little, corrections that are insignificant, that are more like noise in Spider, and the Renko doesn't really display that if you provide an appropriate brick size for the chart to build. Let's go over here to my PowerPoint, and I'm going to go to the next chart type. Let's talk about Kagi. Kagi is an interesting chart type, and if you look at the chart, it reminds me of a little snake or a large snake, the way that it's just going up and down. And the snake, of course, is going to go up and down based on how the prices are moving. And the red line is just going to be an interpretation or an indication that the prices are heading down, whereas when you see the green thick line, it's just an indication that prices are headed up. So, for example, on this screenshot, currently the price of Spider is going up. Let's go ahead and take a look at what Spider is doing currently, because I think that screenshot was taken a long time ago. Let me go here to Kagi. Both charts are set to 5 minutes. So let me go to data, edit symbol on this chart on the left-hand side. I'm going to set it to Kagi. Kagi also has a reversal amount. I'm going to set that to 3. I'm going to set it to a fixed price. I'm going to use, let's use minute data so that we can go back 2 years. And this chart on the right, I'm going to set to daily and set it also to 2 years of data. So you can see, let me open up this chart a little bit. I'm looking at it from the month of September, and I'm going to open up my chart again from the month of September so we can see something that is comparable. Okay, there we go. Yeah, you can see how the charts, if you look at them both at the same time, kind of follow the same direction because they're both on Spider, and I kind of set it, in a way that they are comparable. But look at what's happening right here on this Kagi line. Clearly, we are in a green line, so the prices are going up. And this Kagi line also uses reversals in order to change direction. So even though the green line means that the prices are going up, in some instances, the line will go down, but not necessarily because it's changing direction. It's just following along with those small corrections when the prices are going down. The good thing about this Kagi line is that it still paints the line green, indicating that the overall trend is an uptrend. But if I open this chart more, you can see the two little lines that are very similar to what we saw on the point and figure. We see the little arrow pointing to the current trading price, and we see the other dashed line here towards the top, which is my reversal. The price right now, we are in a down direction. That's because this candle is a down candle. So from the top, it's going down. But if it reaches the new level, which is, this is my reversal up here, if all of a sudden the price continues to go up and it touches that level, the line then will change direction and start going up. Does that make sense? So the direction is not necessarily what the trend is. More of the color is what indicates the direction of the trend. And we can see that from the month of November, we've seen a strong indication of the green line where the prices have headed up. Of course, you can change the reversal amount if you want to filter more some of those small corrections. That's up to you. But I wanted to show you this because it's a very interesting way of charting the markets. The moment, and this is something also interesting about the Kagi line, and the thickness. The thickness of the green is always going to be the same. The red line also has a different thickness, and you can set those here in the style of the symbol. If I go to symbol, but here on the Kagi line, I can go to the style. I can set my green lines a little bit thicker. And then on the red line, I can set those a little bit thicker as well, so they're visible here on the screen, and you can see them a little bit better. But the thickness is just to separate the green from the red. You can make them whatever thickness you want on the chart. But the reason why they change from a red to a green is because it's monitoring the last lowest and highest prices. Let me explain what I mean by that. Currently, the Kagi line is going down. Everybody sees that? If all of a sudden it goes down and it goes lower than this lower low, it'll change color. That's what turns, or that's what decides the color of this Kagi line. As soon as it crosses either the lower point or the upper point. In a red line, for example, as soon as the price goes above the previous high, that's when it turns green. So that decides the color of that Kagi line. Some of the elements of bar building or line building are included in that PDF. And they're also included in the TradeStation help file. So we have good documentation on each one of these lines. So make sure that you go through that if you want to understand how these charts are built in a little bit more detail. Let me go here to my PowerPoint and show you the next bar type, which is range. I'm going to talk about 3 bars, but I want to summarize the next 3 chart types together, which are range, momentum, and case. You can see that the three follow each other right here inside of the PowerPoint or the PDF that was shared with everyone here. So let's talk a little bit about them and what is it that sets the bar building on this chart types. Let me go over here to TradeStation and let's start off with momentum. Momentum is a type of chart that looks at, again, significant price movement. And I said this before, I'm going to say it again, but every one of you needs to determine what is that significant price movement that I should be monitoring in order to set my chart. In this case, this is Spider again. And you can see that on the top left, it says momentum bar 1, because it's looking at a 1-point movement in either direction to create the chart. Let me go ahead and change that a little bit. I'm going to double click and I'm going to leave it at 1 because I want to show you something cool. And I know that using 1 is going to make the math a little bit easier to understand. But let me open up the chart and take a look at a couple things here. First, if I click on the background and I hold my mouse button, take a look at the high and the low inside of the data tips window. Everybody's looking at the high and the low. The high is 451.20 and the low is 450.20. If you do the math, that is exactly 1 point. Every candlestick historically that you find here in the momentum bar is going to be exactly 1 point if you measure from high to low. That's the way that momentum builds every candle. The only candle that is not going to be 1 point is the current one. Even the previous one, if I click and hold, the high is 456.45 and the low is 455.45, exactly 1 point. The current one, the high is 455.48 and the low is 455.09, which means that the size of this candle from high to low is 39 cents. 39 cents, not quite the dollar that we're looking for. So this candle will stay there. It'll stay there at 455.38. And if it doesn't move higher or lower, the candle will continue its size. It'll extend up and down as the market moves up and down. And it'll only close the candle and go to the next one as soon as the difference between the high and the low is exactly 1 point. Hopefully that makes sense. That's the reason why when you go from one candle to the next, you see that momentum. Let me go here and click on here. Let's go. The closing price here is 455.45. And the opening price here, let's see, closing price 455.45. Opening price 455.44. 1 tick lower. Since we were in a down candle, is 1 tick lower. So the next tick is the one that opens up the next candle. Does that make sense? So there's always going to be a 1 penny or 1 cent difference between the closing of one candle and the opening of the next. When you go to the time frame and you want to set up price-based charting, all those higher intervals are just for historical bar building, for you to be able to build candlesticks in history and have enough history to analyze different historical periods. If you leave it at 1 tick, you still have 6 months of historical data, which is great. So if you want to do your analysis over 6 months of data, yeah, just leave it on 1 tick. Just be mindful that tick charts are going to take a little bit longer to load, and that's the only difference. But if you want to go back longer than 6 months, then that's where the higher time frames come into play, and in order for you to load historical data. So we talked about momentum, and I'm running out of time, but I'm just going to finish off connecting these 3 charts together. I'm going to go to range because range is exactly the same. I'm going to go here, arrange vertical. These are both 5 minutes. I'm going to take my data, edit symbol. I'm going to set it to range 1 minute. I'm going to use minute bars and go back 2 years. And on this one, I'm going to set it to daily. And again, this is a chart that goes back to Let me squeeze the chart a little bit. So this is from the beginning of November. I'm going to expand the chart here from the beginning of November. So what you see here in my range bar is what happened right here. One thing that I want to point out is that whenever there is a gap, notice this big gap that happened on November 13th, big gap to November 14th, it closed at 40.40, it opened at 40.46, a 6-point jump, it created that gap. You don't see the gap here on the range bar, and you won't see it on the momentum bar because range and momentum, they create synthetic bars. It's kind of interesting, right? These are bars where trades did not happen, but since the chart is following price movement and the price moved through that gap, it actually paints candlesticks as if there were trades there when there weren't. So just keep that in mind, because on a momentum and on a range bar, there's not going to be any gaps. And you can clearly see that Spider has multiple gaps, when you go on a daily chart. Those are not reflected here because the price movement just fills in the gaps with candlesticks because it represents the price movement. Hopefully that's clear. The only difference between range and momentum, this is what I wanted to get to. The only difference is that range will not wait until the next tick to open the candle. It'll do it immediately. So when you check the closing price of one candle, in this case, the closing price is 450.42, and you check the opening price of the next one is 450.42. So closing to opening is exactly the same, and it doesn't wait for the next tick. Momentum, the name implies that is looking for that next tick in that same direction so that a new candle is created. That's the only difference between momentum and range. Now, case, which is also very similar. Let me go here to, this is case right here. Yes, this is comparing case to range, because case is a type of chart that also looks at a target price. Let me go here to data, edit symbol, and you can see that my target range is set to 1. So the bar building technique, it's the same, where it's trying to reach that 1 point difference between the high and the low. So what's the difference? The difference is that case does not fill in the gaps. Everybody sees this? The gaps that happen in Spider are still reflected in a case bar because case only uses real trades. It doesn't create synthetic bars. So it's an interesting way of looking at the target that you're trying to achieve, because it's only looking at real prices when building the candlesticks. That's the reason why, let me open this up a little bit. That's the reason why when you look at some of these candles, let me find one. Here's one. Take a look at this candle. Take a look at the difference between the high and the low. The high is 455.50. The low is 454.44. So the difference between the high and the low is exactly 96 cents. Not quite the $1 that we were targeting. And the reason for that is because the case bar has a built-in logic that decides where the next tick is going to fall. A lot of times the price jumps, and we see that clearly on a daily chart for spiders, where we see the gap, the price actually jumped. So the case bar makes a decision as to where to include that next price. Does it include it on the bar that's being built, or does it leave it for the following bar? Because if it includes it, it may exceed the target by 1. The target's 1, and it may just exceed it. So sometimes it makes a decision as to where to include that tick, but uses exact price data, and it's not going to fill in the price as momentum, as range do. Let's go ahead and take a look at the last, it's line break, but it's titled incorrectly. It should not say case, it should say line break. Take a look at the first line. It says the line break chart, and this is line break because it's LB on the screenshot. Let me go over here to my TradeStation and show you what the line break does. Line break is, again, monitoring prices. This is let me take a look at what the settings are. This is for line breaks on a daily time frame. It's using daily bars. So what it's doing is tracking the prices on a daily basis and seeing the direction of those prices. So we see that recently those prices have gone up since the beginning of November. Everybody sees November down here. It correlates to November down here. But you can see that the line break doesn't show any of the reds. These small corrections, they're filtered out. The reason for that is because the overall trend is up. It has to reach a certain level for the direction of those columns to change. What is that level? Well, it has to cross the 4 previous columns. So let me explain what that means. On the current bar, it's monitoring 1, 2, 3, and 4 bars previously. So the price has to go below this low in order for it to switch to a red box. That's what the line break means. The 4 line break means that it's looking back 4 bars. Commonly, you can see that this chart sometimes is called the 3 line break because it's the most commonly used, looking back 3 candles or 3 bars or 3 columns, however you want to call it. But TradeStation gives you the ability to monitor more than just 3. For example, if I set this to 3, let me show you what that looks like. Data, edit symbol, and 3. You can see that at one point, it met that criteria. How? Because on this candle, it was monitoring 1, 2, 3. So as soon as it went below this threshold, it created that red candle. So I'm sure that that correlates to this big red candle that's over here. So it's a little bit more sensitive to those price movements. That's how I wanted to explain, the line break, which was the last type of chart that I wanted to cover. But you can see that we have 7 different types of price-based charting, which are very interesting in the way that it removes the noise once you set it to a sweet spot. The sweet spot of every chart is going to have to be interpreted because it changes as the market goes along. So there's no correct number. So look at how the security is moving. You can use, average to range as a gauge to see how much it moves on the time frame that you're analyzing, whether it's daily, intraday, you have to make that analysis. But all these price charts are designed for that purpose, to remove the noise. If you're monitoring volume, then you can use the tick charts and the share bar charts, which are also really convenient. Those are the chart types that we were going to cover today. I'm sorry if I didn't get to your question. I ran out of time. I knew that I had a ton of content to cover, so I apologize if I didn't get to your question. So feel free to email me at education@tradestation.com, and I'll address your questions there. Thank you so much for your time. Have a wonderful afternoon, and I'll see you next time. Check out the event schedule for the next upcoming topics, okay? Great having you, everyone. Goodbye.